You know how Apple makes its billions, right? By selling a ton of iPhones. And Amazon got rich by being the world's biggest everything store. And that part is true. But what about the companies that are worth billions of dollars before they even turn a profit? What if I told you that for many of the tech giants that define our lives, the real money is made in a world you almost never see? A world of high-stakes bets where a good story can be worth more than actual profits, and locking down a market is way more important than making a single dollar from a customer. This isn't about selling more stuff. This is about a hidden playbook that every modern giant, from Uber to Airbnb, has used. It's a playbook of venture capital, massive loans, and blockbuster stock market launches that turns disruptive ideas into billion-dollar realities, often without a cent of profit to show for it. Today, we're not just looking at their products. We're decoding the financial rulebook that really builds empires. Welcome to MBA in Minutes, your spot to get a deeper understanding of complex business concepts in a bite-sized, digestible format. It's your MBA, simplified.
We've all heard the classic business story. You get a great idea, build a product, sell it for a profit, and slowly grow. It's the wholesome Main Street way of doing things. And for millions of small businesses, that's exactly how it works. It's honest, it's simple, and it's slow. But that model can't explain the explosive, almost overnight growth of the companies that shape our world. How does a company go from a college dorm room to a global name in just a few years? How is it worth billions of dollars while reporting staggering losses year after year? The answer is, they aren't playing the same game. They're playing a completely different sport, with a different set of rules, and a totally different way to win. The goal isn't just to make a profit. The goal is to create enterprise value, a powerful, sometimes fuzzy idea of a company's future worth that is so compelling, investors will pour billions in just to get a piece of the action. This isn't about earning your way to the top. It's about being funded there, and the fuel for that rocket ship comes from a world far away from customer sales. The engine behind these billion-dollar companies isn't just revenue from their products. It's a three-stage financial machine built for one thing: insane growth. And it's made up of three pillars: venture capital, strategic debt, and the all-powerful IPO. Pillar number 1, venture capital. Fuel for the fire. Before a startup has millions of customers, it has a story, and it sells that story to a special type of investor called a venture capitalist, or VC. A VC investment isn't a loan. It's a high-risk, high-reward bet. In exchange for millions in funding, founders give up a piece of their company, what's called equity. This money comes in stages or rounds: a seed round, then Series A, B, C, and so on. With each round, the startup gets a huge injection of cash to spend like crazy on marketing, tech, and talent, all to grab as much of the market as they can, as fast as they can. Profitability is not the focus. Growth at all costs is. The idea is that it's better to own 10% of a watermelon than 80% of a grape. VCs are there to help build a watermelon. Think about the early days of Facebook. It wasn't making serious money, but it was gaining millions of users. VCs saw that user growth as a sign of future dominance and poured money in, betting on the potential for future billions, not the current profits. VCs know most of their bets will fail, but they also know that if just one hits big, the payout will be so massive it covers all their other losses, and then some. Pillar number 2, strategic debt. The empire's leverage. Once a company gets bigger, the game changes. They can't just keep giving away pieces of the company forever, because that waters down the ownership of the founders and early investors. So how do they pay for a huge expansion or just buy out a competitor? They use debt. But this isn't like you or me getting a car loan. Billion-dollar companies can borrow massive amounts of money at super low interest rates by issuing bonds or taking out huge corporate loans. They then use this borrowed cash for big strategic moves, like buying other companies. A perfect example is Amazon buying Whole Foods. Amazon didn't just use cash on hand. It financed a huge chunk of the $13.7 billion deal by raising new debt. It borrowed money to buy a massive, ready-made network of grocery stores overnight, instantly giving it a huge footprint to compete with rivals like Walmart. Similarly, look at Microsoft's monster $68.7 billion buyout of the gaming giant Activision Blizzard. That was an all-cash deal, made possible by Microsoft's enormous cash reserves. This wasn't funded by selling more copies of Windows. It was a power move to buy an entire universe of beloved games, from Call of Duty to Candy Crush, making Microsoft a dominant force in gaming. This is financial leverage in its purest form, using your size and wealth to buy market share and future revenue. Pillar number 3. The initial public offering, cashing in the chips. The initial public offering, or IPO, is the moment a private company lists its shares on a stock exchange like the NASDAQ or the New York Stock Exchange and becomes public. For us, it's a chance to finally buy a piece of a brand we love. But for the founders, employees, and early investors, the IPO is something else entirely. It's the exit. This is the day where all the paper wealth, the theoretical value of their shares that has been building up for years, can finally be turned into cold, hard cash. An IPO can make founders and early employees billionaires overnight. And here's the key. A company does not need to be profitable to go public. Companies like Uber and Lyft went public despite a history of losing incredible amounts of money. Why? Because their IPOs weren't just about raising more cash for the company. They were about providing a massive payday for the VCs who had funded them for years. The IPO is what makes the VC's bet pay off, allowing them to sell their stake to the public and walk away with those massive returns they were hoping for. If you're getting some value out of this look behind the curtain and want more deep dives into how business and money really work, do me a favor and hit that like and subscribe button. It's a huge help and lets me know you want more breakdowns just like this one. Now, you may be thinking that this all sounds amazing, but what is beyond the theory? So, to see how this all works in the real world, let's dive into at Airbnb. Today, it's a hospitality giant, but it wasn't built by just renting out rooms. It was built with this exact financial playbook. The Playbook in Action. The Case Study of Airbnb. Step 1. The Venture Capital Rocket Fuel. When Airbnb launched in 2008, it was just a wild idea. To get from a few air mattresses on a floor to a global platform, it needed cash. A lot of it. The company went on the classic VC journey, raising money from legendary firms like Sequoia Capital. Over 15 funding rounds before its IPO, Airbnb raised a stunning $4.4 billion. That money wasn't for turning a slow profit. It was to fund aggressive global expansion, build a brand people trusted, and outmuscle the entire hotel industry, all while the company was still losing money. Step 2. Strategic capital for dominance. Armed with billions, Airbnb could make moves that smaller rivals couldn't even dream of. During the pandemic, when travel completely stopped, the company was able to raise another $1 billion in debt and equity to survive the storm. This allowed them to not just stay afloat, but to pivot their strategy, focusing on long-term stays and local travel. While everyone else was struggling, Airbnb used its financial firepower to get stronger, ready to dominate the rebound. Step 3. The IPO payday. In December 2020, Airbnb pulled off its grand finale, the IPO. The company went public at a valuation of $47 billion. On the very first day of trading, its stock price more than doubled. This single event turned its founders into multi-billionaires and delivered a massive return for the VCs who had backed them for over a decade. The IPO also raised another $3.5 billion in fresh cash for the company, giving it an even bigger war chest for the future. Airbnb's story is the playbook, perfectly executed. So how do billion-dollar companies really make money? For so many of today's giants, it's about more than just the product they sell you. They make money by mastering a hidden financial game. They sell a piece of their future to venture capitalists for the fuel to grow at impossible speeds. They use the power of massive loans to buy competitors and entire markets. And they use the IPO as the ultimate event to turn years of theoretical value into life-changing wealth. In this world, the company itself becomes the product. Its value isn't measured by the profit it makes today, but by its potential to own an entire industry tomorrow. That's the financial engineering that separates a disruptive startup from a small business. It's what builds modern empires. So the next time you see a company with $1 billion valuation that's losing money, you won't be confused. You'll know they're not playing the same game as everyone else. They're playing the long game, using the hidden playbook of modern finance. What company's financial strategy should we break down next? Is there a business whose success just seems like magic? Let me know down in the comments, and don't forget to subscribe for more content that decodes how money and power really work. Thanks for watching.